Right, jet setters. Here we are. It's Tuesday night, Australian time. Tuesday morning US time, something like that. US market has just opened. S&P, new all-time highs. Fantastic. I didn't go short again for a change. I wanted to take a step back and look at some things that are really the root of my concerns and really worries about the markets and the levels. This is the S&P going back, 1975, 1971, whatever, right? And we can see these couple of very clear long-term trends and then turbulence, okay? Now these trends, what do they tell us, right? They're not just lines on paper, right? Technical analysis, sure it's lines on a paper, but you've got to bring it back to what is it saying about reality, right? What is it telling us? What these trends tell us is that this is the normal ebb and flow of economic growth in the US, or equity valuations, okay? This is saying all this, everything was normal. Sure, a few hiccups like the 87 crash in here. Sure, there are a few corrections, but actually it was all normal until here, okay? When not only did we see a correction that's 20% to the bottom of the channel, but we saw normal end, and we saw that's like almost a 50% correction, almost 46%. Same here, right? You could argue that in here, there's another little channel in here, everything was normal, right? For those precious few years, normal was being refound again. But then actually the GFC happened and actually normal finished, and we ended up having to re-find our feet, okay? Since the GFC, this has all been normal, right? Even the COVID disaster was within the realms of normal. I mean, you could draw this like tighter and say, okay, it was just outside. Or you could be a bit more generous and say, look, actually, it was a big correction, but it was still within the realm of normality. Okay, and here we're still in the realm of normality. Okay, but what happens, right? You don't really hang around these high valuations for that long. Touched it, pulled back, hung around for a little bit, big pullback. Touched it, came back, touched it, came back, hugged it for a little bit. But you don't really break through it, at least not in the S&P. So what we're seeing in the S&P is normal, it's at the top, 20% would take us back to the bottom of the range, 20% would be normal, but if we're seeing something that is the end of normal, okay, then we could see a 40 to 50% pullback. I'm worried about that we're approaching something as the end of normal, and this is why. When we go to the NASDAQ, and we see these trends, okay, and what we see here was this is normal, 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 this is insanity, okay, right? Normal, insanity, right? Normal, insanity, right? So just as we saw insanity in the .com era, end in tears, we've seen some insanity here, or we are seeing some insanity here. And when we look at it like on a tighter time frame, let's go down to like a weekly, we can see some slightly disturbing similarities between these phases here, where we can see we've gone from, the bottom of the channel, or below the bottom of the channel, up above it, back tested, there, gone up, had a little bit of a breather, come up, okay, we've got a little double top, or at least a little double top so far. That's what's been happening lately, okay, from right down the bottom, straight through all one direction, bit of a consolidation, okay, another leg up, bit of a pause, another leg up, and a potential turning point, okay? Time will tell. When we look at what happened back in .com, it's a similar thing. From right at the bottom of the range, we go up, we have a bit of a muck around at the top there, we come through here, okay? We have another little consolidation in here, and there we go, bingo, we have a little double top as a turning point, and then it is all over, okay? So that price action, right, that we saw here, we've seen some remarkable similarities here. Whole range, back testing, whole range, back testing, shoots through, little pause, shoots through, little pause, comes up, forms a bit of a topping pattern, all the way back down. Now, when I look at this in conjunction with the S&P, that's what makes me worried, because as I said, these trend channels, right, they do tell you that this is what is normal. When it breaks through to the upside, that says something is not normal, okay? This is normal, this is not. This is normal, this is not. Right, when we look at the RSIs, no doubt we will see these, you know, heavily overbought. Let's have a look at our monthlies. You know, really heavily overbought, right? You know, really heavily overbought. You know, it's been overbought for like a while, right? Been overbought for a while, right? You know, and these things, they do cycle down from these overboughts, right? What happens when they cycle down, right? When they cycle down from these overboughts, from there to there, that was like, you know, well, in terms of the NASDAQ, it was 70% or something, right? 76%, okay? Here was a smaller one, right? 50 something percent, 53%. Now, don't forget, this is the NASDAQ, right? The GFC, right? That was mainly financial stocks, right? You know, but this was the NASDAQ that corrected, right? Where would 50% take us here, right? 7,500. Bingo. Wouldn't that be interesting, right? That would be in line with what happened at the end of .com. Now, I guess the question is, are we seeing a change or the end of a phase in the economy that is as dramatic as .com or the GFC? Now, I would say potentially we are, and that is coming from the 10-year bonds and the bond markets in general, which are telling us that the days of free money are over, okay? So we can see there's a big long-term trend that's been going on, you know, again, same period, from 1987. We've seen these lows and these rates, they ratchet down, and you can see the highs, they ratchet down as well. The interesting thing about this is what happens is we get a low, right? That becomes a level where we shoot through, shoot above it, come back, test it, we have a little kiss goodbye, and then we reset lower. So here's a low here, we go underneath it, over, below, come back, we have a little final last gasp here, we ratchet down again, okay? We have like a low here, low here, we go under, over, under, over, under, over, we have a last kiss goodbye, one here, and there's another one there, okay? And then it's over. Same here, right? Lows here, low here, let's come back, we've had a back test here. Now, to me, this looks like, given the previous action, what happens with these rates when they're ratcheting, you know, we are headed to, like, you know, this level here, right? Certainly this level here, but potentially somewhere in between, right? Now, if we look at the most recent move, as a case in point, okay, it's 167 points. That led to a 20% correction in 2018. Now, just keep in mind that 20% in the S&P would take us through to the bottom of the channel, right? The bottom of the normal channel, right? So 170 point here move, okay? Whoops. Yeah, well, Where does that take us back to? Okay, well, 170 points. Yeah, basically takes us pretty much to this level here, that previous low, right? 165 points. Takes us to that low there, on bang on. So that similar move, right, which led to a 20% correction in 2018, that similar move here would take us back to a level where you would expect these things to ratchet back to, and that's 2%. Now, coincidentally, 2%, that's roughly like, the target inflation level over 2 years. That would leave us that's almost like first base for where these long-term rates should go to, because it means a 2% 10-year bond rate, 2% inflation, you've got 0% real rates, right? So you can't think, if it doesn't go there, then really there is something seriously wrong. Of course there is something seriously wrong. So that's where the US 10 years are positioned. I'm short those. Or short the Aussie ones. And the 2 years, we can see they could really be headed quite easily back to this trend line, and that would be like another 150 points, right? That's 190 points kind of there, right? Up from like 50, so another 150 points. Now, that's just it normalising, right, to this trend, let alone breaking through a trend that goes back to 1990, like a 30-year trend. Now, what is that, those rates, going to spell for the NASDAQ? I mean, those rates, them on the move, they are moving because it is saying that the end of free money, is coming. We know that it is. And what's that going to do to the lunacy that we are here? Now, part of this lunacy is companies like Tesla, which have got a PE ratio of like 400 to 500. They've only just started making a profit, right? So I guess take that as a grain of salt with the PE ratios. But they make cars. Cars are a commodity. The electric engine, there's nothing new about the electric engine. It's been around for like decades, right? And there are no shortage of other makers who will be able to make as better or cheaper cars than Tesla. Tesla is $1 trillion company on a PE of 400 or more, and that's the kind of stuff that's driving these ridiculous valuations. And we know as a fact that's normal. This is outside of normal. This was normal. This was outside of normal. And what happens when normal ends? Okay, we get a big, big correction. And the other thing I'll kind of point out with the 10 years, there's T2 bonds, they've been heavily oversold. Okay, and this is on a monthly, right? Heavily oversold here. Okay. When we go back to here, they're heavily oversold here. What do? They ratchet right back up. Heavily oversold here, just a little bit there, but here, what do? They ratchet right back up to the top of that trend. Here, oversold here. What do when they get overbought? They go right back to the top of that trend, right? Here, oversold. They shoot back up. This one wasn't as strong, didn't go all the way back up here. Here, oversold, right? They haven't even become overbought yet. It's overbought there, close to overbought there, close to overbought there, not totally overbought, close to overbought there. It's still got like a long way to run before it gets overbought, and it's already at the top of this trend. Okay? So for it to get anywhere near this level of being overbought, even that level of being overbought, even here, let alone here, or even seriously overbought, right? It's going to bust through this line. Okay, so it's going to break this trend, okay, and it's going to go somewhere between 2.2% and 3.2%. Okay, I'd say 3.2%. How is that going to look on the NASDAQ? And as the NASDAQ corrects from its level of lunacy, what's it going to do to the S&P? Okay, as I said, 20% from there to the bottom of the range. 45% is in line with what we've seen the last time the S&P, the last time the NASDAQ recovered from its level of lunacy. Okay, GFC again like 53%, right? So that's my concern, right? It's not just this 20% here, right? Because all these other moves have been up and down moves have been when the NASDAQ has been within the range of normal. Okay, we are now in a situation though where the NASDAQ is clearly at historically ludicrous levels, where it could go further, but when it blows in a substantial way. That is my concern, and that's what I've got my eyes on. The way I'm positioned for that is I'm waiting for opportunities to short the equity markets, but really I'm short the bonds because I think that's where this disaster could potentially unfold from. Anyway, that's it for today. Ciao.